Join me as I dive deep into the crude oil markets and challenge everything you thought you knew about them with insights from an ex-oil trader. As an ex-oil trader, I've had the privilege of being on the inside of the crude oil markets, and I've seen firsthand how complex and misunderstood they are. With the world's energy demands constantly shifting, it's clear that understanding the crude oil market is crucial for anyone interested in navigating the complex world of finance. But before we dive in, it's essential to acknowledge that the insights I'm about to share come from my unique perspective as someone who's been in the trenches, dealing with the ups and downs of crude oil trading. One of the biggest misconceptions about the crude oil market is that it's all about supply and demand. While that's true to an extent, there are so many other factors at play that can influence the market. For instance, traders often overlook the role of geopolitical events like wars or economic sanctions, which can have a significant impact on oil prices. Another common mistake is thinking that crude oil prices are solely dictated by OPEC, but that's not always the case. In reality, there are many other players involved, from independent oil producers to refineries, that can influence the price of oil. Traders also often underestimate the complexity of the oil market. It's not just about buying and selling oil, it's about understanding the intricacies of the global energy landscape. For example, did you know that there are different types of crude oil, each with its own unique characteristics and uses? Understanding these differences is crucial for making informed trading decisions. Furthermore, the oil market is highly susceptible to speculation, which can lead to dramatic price swings. As a trader, it's essential to separate fact from fiction and stay focused on the underlying fundamentals. Another challenge traders face is the sheer volatility of the oil market. Prices can fluctuate wildly in response to even the slightest news or event. This makes it difficult to predict what will happen next, and means that traders need to be constantly adapting their strategies to stay ahead of the game. In addition, the oil market is highly opaque, making it difficult to get accurate information in real time. This lack of transparency can make it challenging for traders to make informed decisions and can lead to costly mistakes. The mechanisms of oil trading are multifaceted and complex. One of the key factors influencing the market is pricing. The price of oil is determined by a complex interplay of supply and demand, as well as a range of other factors, including production costs, transportation costs, and global events. Another critical component is the role of supply and demand dynamics. As the global energy landscape shifts, demand for different types of oil is changing, which can have a significant impact on prices. For instance, the rise of electric vehicles is leading to a decrease in demand for gasoline, which can put downward pressure on prices. Geopolitical factors also play a significant role in the oil market. Political instability in major oil-producing countries can lead to supply disruptions, which can drive prices up. Similarly, economic sanctions can have a major impact on oil prices, as we've seen in recent years. Furthermore, natural disasters such as hurricanes or wildfires can also disrupt oil production and transportation, leading to price volatility. In addition, the role of speculation cannot be overstated. Speculators can drive prices up or down based on their expectations of future market trends. One of the most significant events that impacted the oil market was the 2014 oil price collapse. At the time, I was working as an oil trader, and I saw firsthand the chaos that ensued. The collapse was triggered by a combination of factors, including increased production from US shale oil, decreased demand from China, and changes to OPEC's production policies. But what most people don't know is that there was also a significant amount of speculation involved. Hedge funds and other investors were betting heavily on oil prices going up, which led to a massive bubble. When the bubble burst, prices plummeted, catching many traders off guard. As an insider, I saw the panic and confusion that ensued. Many traders were caught off guard and losses were significant. But looking back, it's clear that the collapse was a result of a combination of factors, including speculation and geopolitical events. This experience taught me the importance of staying focused on the fundamentals and not getting caught up in speculation. It also highlighted the need for traders to be constantly adapting to changing market conditions. In another instance, I remember being involved in a deal that involved transporting oil from the Middle East to Europe. What most people don't realize is that the route that oil takes can have a significant impact on prices. In this case, the oil was being transported through a narrow strait, which made it vulnerable to disruptions. When tensions rose between two countries in the region, the strait was closed and prices shot up. This experience taught me the importance of understanding the intricacies of the global oil supply chain and the potential risks involved. The key takeaway from my experiences as an oil trader is that the crude oil market is complex, volatile, and highly susceptible to speculation. To succeed in this environment, traders need to be constantly adapting, staying focused on the fundamentals, and avoiding getting caught up in speculation. It's also essential to understand the intricacies of the global oil supply chain and the potential risks involved. Thanks for watching, and I hope you've gained some valuable insights into the world of crude oil trading. If you have any thoughts or questions about the oil market, please leave them in the comments below. And if you want to learn more about the world of finance, be sure to check out my other videos. Make the background music inspiring.